as a new trader, when you hear the word spread, what comes to your mind? What do you think spread is? In this video, we're going to be explaining spread in detail, what spread is, how it affects your trading, and what you need to know about spread. So let's get into the video proper. Understanding spread. Now, theoretically, spread is the difference between the bid and the ask price. Spread is Spread is the difference between the bid and the ask price. So we say bid and ask. So let me start by making it a little bit simple before we go into it being technical. Now let's use this book. This is my book, the Forex Millionaire's Blueprint. Let's use it for this illustration. I sell the book $7. That's the cost of the book, $7, and that is my price. So let's say a wholesaler buys it from me. Perhaps he's buying 1,000 copies, and I choose to give him discount. I sell it to him at $6. So he buys from me at $6 per copy, buys 1,000 copies, and he knows that my market rate is $7. Being that he knows that no individual will be able to buy it from me cheaper than $7. He also knows the hassle that the individual trader will need to go through in order to get to me and get this book, coupled with the fact that the person will also have to pay for shipping. You're getting me? So he could choose to sell the book at $7.5. You understand? That's $7.50. He could choose to sell it at that rate. Knowing that any individual who wants to buy it directly from me will pay the $7, which is the actual cost, and pay for shipping, which could be maybe $2. And it will be cheaper for that trader to buy directly from the, let's say, wholesaler or retailer who bought from me at $6. So that difference between the market price and what the wholesaler is willing to sell it to him is called spread. So we say that spread is the difference between the bid and the ask price, which is the difference between the price, the market, the actual price in the market, and what the broker is willing to give you for. Do you understand? So spread is the difference between the actual price of that asset in the live market and what the broker is willing to give you for. So spread is the reason why when you take a trade, you start on a negative balance. So this is why it is always recommended that you trade with a broker that have reasonably tight spread, because when you do that, that difference will not be much. If it's a broker that doesn't have reasonably tight spread, that difference will be much. And in case you don't know, this occurs in every single trade you take, whether it ends in profit or it ends in loss. Whether you took the trade by mistake and decided to close it, you are charged spread. In fact, let's say you had $1,000 account and you mistakenly take a trade with 5 standard lots and you decide to close it immediately, you will pay spread for that one before going back to trade it with the normal lot size that you would have loved to trade that account. So for every transaction that happens on your trading account, the broker charges you a spread. So spread is that important. You need to be aware of spread. In fact, spread is part of the silent killers of traders. Traders give attention to profit and loss, unknowing to them that spread, swap, commission, these are things that the broker takes silently, irrespective of whether you make profit or loss. They keep taking this from every trade you take, and this keep accumulating and making them money. So you need to give attention to spread in every trade you take. If not, you will be making money for the broker. The broker will make money from you and you'll be the one losing because they have to make their money. That is the fact. It's the cost of the transaction. They have to charge it. So I said that spread is the reason why every trade you take starts on a negative balance. So when you take a trade and you see it is always going to start on a negative balance until this difference is covered. So let's say you entered here and this is where, let's say you want to take a buy. This is where the market is. Immediately you take the trade, you'll see that this is where you're entering. So the market needs to move from this point to this point. So we call point A is your entry, point B is where you're supposed to enter, or where you thought you were entering, until the market moves from A to B and exceed it. That is when your profit will start. Until then, you are still in loss. You understand? So imagine, let's say, theoretically, this difference is 1 pip. So the market needs to make 1 pip to cover this difference. Imagine if it was wide, if it was 2 pips, or 3, or on a bad day or a terrible broker, it is 10. This also depends on the currency pair you're trading. If it is 10, so you need to make 10 pips to cover this difference. If not, you'll still be in loss. And if you decide to close when it has not covered this difference, you are closing in loss and you are the one to bear that cost. So spread is very important in trading, and like I said, it is part of the silent killers of traders, and you need to give attention to it.